Welcome back. We are now in chapter 9. In this chapter we'll be discussing about non-fund limits. So far our discussion has been focused on the fund-based limits. So whatever facilities we discussed till now, the term loan, right, both long-term loans and short-term loans, and the working capital limits, whether it could be OCC or SOD or PC, all those limits are fund-based limits. So in this chapter we'll be discussing about non-fund limits. So at the outset, let us see what is the difference between a fund-based limit and a non-fund-based limit, right? Term loans, CC limits, these limits are called fund-based facilities because the bank is parting, right? Bank is parting with these funds. So bank has some funds, say 2 crores, and a party has come, and the bank is physically transferring this cash to the party. So bank is parting with the funds. That's why we call them as a fund-based limits. It is possible that there are facilities where the bank will not part with funds. Okay, so bank does not give any funds to the company, right? These are the non-fund limits which we are going to discuss, right? These are LCs and BGs. So what happens in these situations is, party is sanctioned, say for example, a 2 crores LC limit. Bank will not release 2 crores to the party, right? That's why it's called non-fund, right? It is non-fund in the sense that the bank is not giving any funds to the party, but it's a limit, right? It is a limit, it's sanctioned as a limit. LC and BG are limits, but they are non-fund limits. Why do they do that? Well, that's what we're going to discuss in this chapter, but the fundamental difference being that fund-based limits mean bank parts with money, it gives money to the party, right? Non-fund limits basically are just a piece of paper, right? Basically they are document based. There's no money involved. Money will get involved at a later stage should the situation arise. We're going to discuss something called invocation of BG, right? Devolvement of LC, where a non-fund limit can result in being converted into a fund-based facility, but that is different, right? We'll come to that later. Fundamental difference is, in a non-fund limit, bank does not part with any money, right? It will not directly give funds to the advance party, right? So the two most important non-fund limits which you're going to normally encounter in your banking careers is LCs and BGs. Right? The first one is LCs, right? Letter of credit. It's known as letter of credit. So basically, a letter of credit is a payment mechanism. Just remember that it's a payment mechanism, right? Payments can be made in a variety of ways. So what are the various payment methods that you as an individual can do? Say for example, you have made a purchase, right? You have made a purchase. So see, how many ways can you or make payment for this purchase, right? You can straight away pay cash, right? Directly you can pay cash, or you can pay with your credit card, right? Or you can pay with your debit card, right? That is also a mechanism. Or you can pay with some vouchers, right? Some vouchers, right? For example, your Sodexo passes, right? All these are payment mechanisms, right? It's not just cash. Cash is not the only method of payment. There are various methods, even for a individual payment. There are a variety of methods. So you can imagine in a business context, obviously there are going to be a variety of payment methods. Yes, what are the normal methods? We are aware is a cash payment, right? And then maybe through checks, right? DDs. These are the normal payment mechanism. But in international trade, right? There's something called LC. This is a very popular payment mechanism. But letter of credit is a payment mechanism, right? First of all, it is a payment mechanism. So why does this arise? Okay. So let us assume that you are a manufacturer. You are a steel manufacturer. Okay. So you are in India, right? Say based in some city, in some remote city, right? Say some tier 3 city. It's not a major city like your Delhi or Mumbai or Hyderabad. Right? It's a tier 3 city where and you want to set up a new project, right? A steel manufacturer. You are a steel manufacturer. You want to set up a new project for which you require a machine. Now let us first of all assume that it is available in your city. Okay. Let us assume that though it's a small city, let us as a starting case, let us assume that this machine is available in your city. So what you do, you just walk up to your to this machinery supplier, you talk to him, you tell him his requirement, he will list out what are the various products he's got, and finally agree with the bargain on the price, and he agrees to supply it. It's a very simple process. Okay. The advantage here is both of you are local. Okay. So definitely there is a degree of comfort. So in what ways this comfort arises? See, if it is a cash transaction, whether it's local or whether it's foreign, there's no question of comfort or non-comfort, right? If it's a cash transaction, it's then and there settled. It is settled then and there, and we need not talk about comfort. But because it's a credit sale, right? then you need to be worried about comfort, right? If you say to the supplier, I'm not going to pay you now, please give me 30 days credit, will the supplier feel comfortable? That's what we are talking about. This comfort, because both of you are local, right? There'll be a degree of comfort to the supplier, because he can make independent inquiries, right? He can make some local inquiries with the other firms which he knows, right? Once the credit period is over, say after 30 days, he can personally walk up to you, right, and follow for the recovery. And in case you fail to make the payment, he can take legal action. And legal action, though it is expensive, considering that both of you are local, it is not that expensive compared to other options which you're going to consider. So this is a scenario which you consider both of you in the same city, right? Now consider the second scenario where this machine is not available in your city, right? You're from a small city, right? It's not available in the city. Now there is now let us assume this is a specialized machine that is available only in very few select places in the country, and you found out that most of the buyers are preferring to buy this machine from Ludhiana. Okay, so what do? You make some inquiries with that. You personally communicate with that supplier in Ludhiana. He doesn't know you. You do not know him. But so now if you want to make this purchase, right? The seller will prefer a cash transaction, right? He will say, I don't know you. You are from some other city. I don't know you. What if you don't pay? So I'll prefer a cash transaction. Please pay me 100% advance. But you will say, from your side, you will say, I want some credit period. You know, I'll pay you after 30 days or 45 days. So the problem for the supplier is, if he doesn't give credit, he will lose your order, right? Because if this is the way he's going to run his business, he will not get any business outside Ludhiana. All that he has to be content with this business from his city, right? So he has to deal with credit sales to expand his business. But in doing so, he's taking a risk, right? He's taking a risk. What are the risks? What are the various risks he's taking? One, he cannot make any independent inquiries, local inquiries, right? Because he's not near your city, right? He's far away somewhere in Punjab, and he cannot make local inquiries. What sort of a customer are you? What is your credit worthiness, right? What are your past dealings with your suppliers? So it's not easy to make local inquiries. And in case you don't pay after the due date, now the best he can do is he can just make phone calls to you. Now he can meet personally, but that will be time consuming, because you are not his only borrower, okay? Because he's an all India supplier. He's supplying his machines to various cities. So he cannot personally go and visit, follow for recovery for each and every buyer who has not paid in time. Okay. So also the legal action will be expensive for the same reasons, right? He cannot visit many times. So due to all these problems, the comfort level for the supplier to sell on credit to you will be less, right? But despite all this, he does that because it's a business necessity to expand his business. He has to sell on credit, so maybe he takes that risk. Now let us extend this to a scenario where this machine is not available in this country, right? It has to be imported. Or let us say this is a machine that is available, but you found out through your research that from your other competitors that the best machine is of this category is available only in Germany. So all your competitors are purchasing this machinery from Germany, and you, in order to compete on the quality front, you have to purchase it from Germany. Now for the German supplier, right? Let us see what is the comfort level. Absolutely zero, right? He doesn't know you personally. He doesn't know your credentials, right? He is not at all comfortable in to sell this machinery on credit to you, because in case you don't repay in time, if you fail to pay, it's just out of question for him to come to India and personally follow up, right? Because look at it from the perspective of the international supplier. When he has buyers from various countries, all over the world, he cannot go to each and every country, each and every buyer and follow up for recovery. That is out of question, right? So he always says, I want to cash sale. But again, the same problem arises. If he insists on cash sales, he's not going to expand his business, right? So it's not only that. There is another reason. The second reason. There is another reason why that doesn't work, because it is not acceptable to you, right? What if you give 100% advance, right? You pay 100% advance, and then you find out that the machine is not working, or it is not as per the specifications. Now the roles are reversed. Now you can't go to Germany and follow up with the seller for return of the amount. So from both point of the supplier and the buyer, there are problems, especially in international trade, right? This cash sale is always preferred by the seller. He wants, give me 100% advance cash payment, right? As a buyer, you say, I will pay 100. I want 100% credit. I will just get the product. I'll check it and then give you. So this tussle always goes on, right? Right. It is perfectly normal both from both the angles. It's perfectly normal from the buyer point of view. The problem is if he parts with his machine, that's it. I mean, if he doesn't get the money, it's very unlikely he's going to recover it, right? That is what is worrying the supplier. From the buyer is also getting worried. Now, if he gives the entire 100% advance, right? If the machine doesn't arrive or is not as per the specification, right? His money is not going to be. His money is not going to come back. So for both the parties, right? For both the parties, international trade is a risky business, especially dealing in credit, right? Credit sales, credit purchases are risky propositions for business persons. So to address these problems, a payment mechanism has emerged, right? This is known as letter of credit. From now on, we are going to refer to as LC. Okay, it's not just in international trade, even in domestic trade, right? LCs are popular. In which case, we refer to them as ILCs. ILC is inland letter of credit. Okay, compare that with FLC is a foreign letter of credit. So letter of credit is a payment mechanism. Why it has emerged? I told you, it is to replace the trust. There is a mistrust between the supplier and the buyer, the foreign parties. Okay, we're speaking. Let us restrict ourselves to international trade. So you are a domestic buyer in India, based in India. There is a foreign supplier, a machinery supplier in Germany. Now there is a mistrust between both of you. We discuss the reasons for this. Okay, you as a buyer are scared that if you pay the amount, the machine may not arrive, or it's a faulty machine. Okay, the seller is scared if he gives it on credit, if the buyer don't pay, it's very difficult to get back that money. So enter the bankers. The bankers come into the picture. So LC is a payment mechanism to replace this mistrust between the foreign parties. So how it works, let us see. So in a normal transaction, okay, this is a normal transaction. What happens is there is a buyer, right? There is a buyer, and there will be a seller. Okay, this is a simple transaction. So this could be cash or credit, whatever it is. There are only two parties involved. There is a buyer and the seller. Maybe some middleman, but basically this is the two mere parties. Let us see the distinction in LC. Right? In LC, two additional parties enter the picture. So the buyer and the seller will not interact directly. See, in the first case, buyer and seller are interacting directly. But in the case of LC, the buyer and the seller are separated. They don't deal directly. Right? See, the initial, we are speaking for the payment part. Okay, the payment part. Initially, they might interact, right, for negotiation and negotiation on the price and specification and things like that. That's okay. Right? We're speaking for the payment part. For the payment part, in a normal transaction, they are dealing directly, right? But in an LC payment, the buyer and seller are separated, right? So in between the buyer and seller, two parties enter, right? One is the buyer's bank. The buyer will be having his banker, right? He's dealing with his banker, right? So the seller will also be having his own banker, right? Right? This is seller's bank. Now the transaction, the LC transaction, the payment will be routed between the banks, the buyer bank and the seller bank, in as far as the payment is concerned. Okay, we are speaking from the payment point of view. The payment will be dealt only by the buyers and the seller's bank. Okay, so the buyer and the seller actually will not come into the picture, right, for the payment. So how it is going to work, right? Let us see how it's going to work. So first of all, the buyer will approach his banker and request to open an LC, right? So let us take the example of we are an Indian manufacturer. We want to purchase a machine from Germany. Okay, so we approach a banker, let us say SBI. Okay, we go to a banker and we request the banker to open an LC. Okay, so what our bank SBI does is it opens an LC and it communicates to the seller's bank, right? The banks won't deal with the parties. Okay, the buyer's bank will communicate to the seller's bank, right? Various ways, usually through SWIFT, right? But it could be any other way. Okay, let us focus on the process. Okay, so somehow it communicates that the LC is open to the seller's bank. Now what the seller's bank, let us assume this is Deutsche Bank. Okay, this is Deutsche Bank in Germany. Okay, so what the seller's bank, the seller's bank is Deutsche Bank. Okay, now Deutsche Bank informs its customer, okay, that is the machinery supplier, right? So what this seller will come, he'll come and check the details of the LC. He'll check that everything is in order, right? Because there is behind this there is a agreement, okay, commercial agreement. So is this LC matching the commercial agreement, right? If everything is in proper, and if he is satisfied that he can supply this machinery in time as per the terms of the LC, right? Everything is fine, or else there will be an amendment to an LC. LCs can be amended, right? We'll come to that later, but let us for the moment assume that the supplier is happy with the terms of the LC, right? So once it is ensured that the LC is in order in all respects, the seller will proceed to prepare his machine, right? As per the specifications, he will prepare the machine, manufacture the machine, and just ship it the material. In this case, the machine. He will ship the machine. Now, what he does after shipping the a machine is, he'll go to his banker and submit some proof that he has actually shipped this machine. Okay. Now, this part is very important. The bank, that's the Deutsche Bank, the buyer's bank, the seller's bank, Deutsche Bank, will not physically go to the port and inquire with the shipping company that whether this machine was actually shipped or not. The banks won't do that. Banks deal only with documents, right? All bank in LCs, as far as LCs is concerned, all banks are concerned is about the documents. This is a very important feature of LC. Banks are not worried about the underlying transaction. What is this? There is an underlying transaction to this, right? That is what is this transaction? Is a sale and purchase of a machine. But banks are not concerned about this. All banks are interested whether there is documentary proof supporting that this transaction has taken place. That's it. So Deutsche Bank. So what this seller will do is, he will ship the machine, right? He will get some proof documents from the shipping company and various other documents which we'll see. Okay, and he'll take these documents to his banker, to Deutsche Bank, and he will submit this proof saying that I have shipped the material, I've shipped the machine, right? What are those documents? We will see shortly. Okay, there is something called bill of lading. There are various proofs to be submitted, which we'll see shortly. But this is the step. Now, what the bank does is, Deutsche Bank, right? It will check these documents, right? And if it is compliant, right? If it is compliant, it pays the amount to the seller. Okay, immediately or at a later time if it's a user's transaction. In that case, Deutsche Bank will credit to the seller's account at a later time, whatever it is, right? So out of the four parties, right? We spoke there are four parties, right? There are four parties. There is a buyer, there is a seller, there is a buyer's bank and a seller's bank. So till now we have seen that the seller has already got his money from the seller's bank. Deutsche Bank has already paid to the machinery supplier. So his part is over. Now SBI has reimbursed to Deutsche Bank, seller's bank. So his part is also over. Now these two are left, right? So what SBI will do is, right? It will call the call the buyer. That is, it will call us and say that these are documents. You can go and collect the cargo, right? Because these documents are to be submitted in order for the cargo to be released, right? See, these documents are not handed over to the customer directly. See, the Deutsche Bank has sent the documents to SBI. Okay, so the SBI is in possession of the documents, right? Now SBI will give, if there is account balance, if they balance in the account, and it will provide these documents to the buyer, provided of course the reimbursement has been done. Okay, this is assuming that there is sufficient funds in the account of the customer, in our account, that is, and the account was debited and funds was transferred to the Deutsche Bank. Okay, that is the assumption. So once everything is fine, so the bank will hand over the documents to us and we can go and release the cargo from the port. Okay, so that is the broad mechanism how LC functions. So we discussed that the most important part in an LC transaction is the documents. Banks deal only in documents. So let us see what are the various documents that are involved in an LC process. Okay, first one is something called packing list. Okay, so packing list is prepared by the machinery supplier, that is a seller. Okay, so what he does is, he prepares a list, right? It will contain details of the contents of this particular shipment. What is the shipment contain, what is the measurements, what is the weight, right? Not only for the information of the customer, but also for the government authorities and transport agencies who require this information. Okay, so that is something called packing list. Okay, that is one of the documents that is required. So there is something called AWB, that is an air consignment bill. This is a airway bill. Okay, so this is a receipt issued by a international airlines carrier in evidence that the goods have been shipped. Okay, so it is required because it is a confirmation that the goods have been goods have been received by the airline carrier, right? We don't know whether they have been shipped or not, but it has been received, because it has been received by the airline carrier, right? In which flight it will send is a different matter, but the seller has delivered this machine to the airline carrier and got the receipt that they have taken possession of the machine. Okay, so that is an airway bill. That is in case of an airline. Okay, there's something called bill of lading. This is for ships. This is in case of water transport, ships, right? So the shipping agency, right, will be giving this document, right? It is a proof that goods have been shipped on board. Whether shipment has happened or not is a different issue. Okay, the goods have been placed on board of the ship. Okay, so this is something with the shipping company will be given to the seller. Okay, there's something called inspection certificate. Inspection certificate is not actually mandatory in every case. This can be insisted by the buyer, for example, not by the seller, by the buyer. For example, if we, because this is an international trade, okay, we don't know. Say for example, this is some material, some chemical, okay, some chemical which is used in drugs, okay. So we want to be very sure of the purity of this material, right? Now again, once the shipment is done and it's not as per and then we do some testing in our laboratory, it's not as per specification, returning the goods is all a headache. Okay, so sometimes in situations where we are very particular about the quality of the shipment, we can ask the seller to arrange for something called inspection certificate. So the seller will be getting the inspection done by an independent third party agency, okay, and they will be supplying this inspection certificate. They are parties who do this, right? For a fee they do this, for a commission they do this. So it's not mandatory, but if the buyer insists, it has to be supplied. Okay, then there's something called certificate of origin, right? Certificate of origin is required by the customs authority because it confirms the originating country, right? From which country are these goods originating, because based on this they'll be calculating the import duty, right? So that is important. There's something called invoice document. Obviously invoice document is provided by the seller to the buyer. Okay, right? So this invoice again is it's used by the customs authority to evaluate taxation. There is insurance policy, so this certifies that the goods transport have been insured, because the transportation is fraught with risk both in shipping and airlines. So it's a safe way to protect the goods. Okay, so these are the various documents you normally come across in a international trade. Then there are some other terms which we need to be aware of when dealing with LCs. Usually come across a term called documentary credit. Don't be scared. Documentary credit is a technical term for LC. Okay, right? Because basically, why the term document? We already discussed this. Banks deal in documents. The LCs, banks are not considered about the underlying transaction. They're all worried. All they are worried is the documents. So this is known as a documentary credit. Okay, right? The banks deal in documents. Right? So why are banks doing this? You know, of course for a commission. That's not the point. The idea here is they are shifting the risk from the actual buyer to bank, right? And thereby they are gaining some commission. Why are banks doing this? They are taking the risk. For example, if we are the buyer and we are purchasing that machinery from the German supplier, right? Now we can be certain, right? We can be certain that certain norms have been followed, right? That the machine has really been dispatched, really been shipped, right? So there's documentary proof the bank is providing us. So there's a comfort to us. Okay. So before making the payment, right? We know everything is in order, right? So the risk has been transferred from the buyer to a bank, and thereby to bear that risk, bank is charging some commission. Okay. So some other terms which you need to be aware of: applicant, the buyer is known as applicant. We who is purchasing the machinery, we are the applicant, right? The seller is known as the beneficiary. Okay. And then issuing bank is SBI in this case. Advising bank is the country in the right is the seller's bank. Okay. Then sometimes you come across a term called revocable LC and irrevocable LC. Usually LCs are irrevocable. That means it cannot be changed unless both the parties agree, both the buyers and sellers agree, right? Usually that is irrevocable. But there is something called revocable LCs, in which case it means the changes to the LCs can be made. Okay. Then two other terms which are very common, you will come across this very commonly: DP and DA, right? This is nothing but site LC and usance LC. So DP, it means cash against documents or cash on delivery, right? So what it means is, the let's take the example which we've been discussing. SBI will hand over the documents. We said that SBI will hand over the documents to us, okay, and so that we can go and take delivery from the port, right? In DP, what the bank does is, it will hand over these documents to us only when we pay the bill. Usually some period is given, some say 3 days, right? Within 3 days of the presentation of the LC of the bill, if we make the payment, the bank will release the documents to us, okay? So that is DP. There's something called DA, documents against acceptance. This is something called, is also known as usance LCs, okay? So here the payment is not made immediately, okay? There will be some usance period, say 30 days, right? So what the bank does is, we'll go and accept the bill, right? And then the bank will hand over the documents to us. We'll go to the port, we'll take delivery of the machine, right? And after 30 days we'll be arranging for the payment, okay? That is usance LC, okay? That is known as DA, document against acceptance. Two types of LC. Site LC, this is known as site LC, right? This is known as usance LC, okay? One more term you will usually come across in LCC is UCPDC, right? This is actually framed by ICC, that's International Chambers of Commerce. This is think of it as a set of rules, right? A set of rules, because LC is a very popular payment mechanism. A lot of international banks are involved, a lot of countries are involved. So in international trade there is a need for some uniformity. Otherwise, if each country and each bank follows its own procedures, right, things will be very messy. So ICC, the International Chambers of Commerce, have framed certain guidelines. Think of UCPDC as a set of rules, okay, for LCs. So, and these are accepted. These are used by all banks and all commercial parties, right, including India, right? Whoever is involved in payment mechanism through LCs, right, will follow the UCPDC norms, okay. There's also a term called Incoterms, right? Incoterms is not exactly related to LC, but in international trade, international shipping, right? Incoterms have been developed by the ICC. So the International Chamber of Commerce have developed some terms known as Incoterms. These are the international commercial terms to provide a common terminology in international shipping. So these are the two terms which you can come across. Now, one problem which parties face with the LCs, it is a very irritating feature. There's something called strict compliance, right? Banks insist on strict compliance. What do we mean by strict compliance? In some cases, banks agree for substantial compliance. We'll see what is this. Take this example, okay? A letter of credit is calling for goods based on this description: iron ore lumps, minimum purity 80%. So the exporter, right, the foreign party, has presented an invoice saying iron ore lumps 90% purity. As a buyer, we are not worried about this, because the purity in fact is more, right? We'll take delivery of the shipment, no problem, right? But bankers reject the documents in many cases on the grounds that there is a discrepancy in the goods description between the LC terms and the actual invoice, right? So this can be very irritating. There are a number of cases, right? There's a number of cases, maybe not known to the bankers, but right, number of cases where these trivial variations will result in rejection of the LC, right? So that is one that is one problem with LCs, right? It could be extremely frustrating for the parties, because it will lead to a lot of delay, right? But even then, in spite of that, LC continues to be the most important international payment mechanism, and we have to live with it. A very popular mechanism. Banks obtain. So what banks get from this is, banks get commission, right? It's a very good income generating avenue, right? So having seen the basics of LC, let us see how LC assessment is done, right? If a party approaches the bank for sanction of LC limit, how are you going to assess that limit? So this is the basic methodology most banks follow, right? So if a company comes for assessment of for applying for LC limit, this is how they assess. Usually it will be one of these, either site LC or usance LC. Let us deal with usance LC, because this is slightly more this is more common and slightly more complicated than site LC. Okay, basic procedure is same. So we are assuming that the LC is for import of material. Okay, so a company is importing raw material, right, from abroad. Okay, so for that let us see, it is come to us for fixing some LC limit, right? Let us see how it's calculated. So what banks do is, first of all, they'll calculate what is the total annual purchase or import, right? And for the full year, how much the company is purchasing, maybe say 100 lakhs. Maybe this is the annual purchase of raw material for the company. So out of this, what is on credit basis they calculate, right? Because if it is in cash, there is no question of LC. LC is a credit payment, right? So let us assume this is 100%. Okay, entire purchase the company is making is on credit basis. So then what we have to see is, out of this, right, how much is being made on use and LC basis. Okay, because entire purchase need not be through LC only, right? There might be some domestic purchases. If we are a manufacturer based in let's say Bombay, right, our mix of raw material could be say 30% indigenous and 70% imported. It could be, right? So out of this total requirement of 100 lakhs raw material, how much is it we are going to import on an LC, use and LC, because this is use and LC, right? On use and LC, how much are we going to require? So say 70 lakhs. Okay, so this is the annual requirement of imported raw material. So let us calculate per month how much it's coming, right? So let us assume this is 72, right? 72 by 12, right? So 6 lakhs per month. The company is going to require 6 lakhs worth of is going to import 6 lakhs worth of raw material. Okay, then there's something called lead time. This is not a supplier. The supplier is not in a neighborhood. Yeah, it's not a next door neighbor. He's situated across the ocean. So there will be some lead time, right? There will be time in ordering. There will be time in negotiation, right? Actual shipment takes time, because it's come to, it has to, it's not delivered through flight. Okay, it's usually through the international waters, right, to the shipping company. So there will be lead time. So let's say it's a 2 months lead time. Okay, then there's something called use-on period. Use-on period, as we discussed, is a sort of credit period. After receiving the documents, how much time we can give to the party for payment. Okay, so let us assume this is a 30 days use-ons, 1 month. Okay, so to calculate use-on LC requirement, what banks do is they will multiply the 6 lakhs with the total of lead time and use-on period. Okay, so this is 3 months total. So total is 18 lakhs. This is how they fix the LC limit, right? If it's a site limit, if it's a site LC limit, same process, except that the difference comes in the use-on period. Use-on period is applicable only for use-on LC. So here there won't be use-on LC. Okay, so let us assume this is 50 lakhs. 50 lakhs average is some 4 lakhs. Okay, lead time, let us say again 1 month, but there won't be any use-ons. Okay, so 4 lakhs into 1, this is 4 lakhs. 4 lakhs into 1, 4 lakhs. Okay, so total 22, like that. This is how it is fixed. The calculation is pretty simple. Okay, and most of the banks will be having Excel based templates to just feed in the figures, and it automatically gets populated, right? Now when dealing with LC limits, one thing we have to be very particular. This is something which we discussed earlier also. The sundry creditors. Okay, the LC requirement should be reflected in the build-up of sundry creditors. That is an extremely important point, right? If a company is having LC limit, right, and that is not reflected in the sundry creditors, basically it amounts to double finance, right? Because remember how we are calculating MBBF. So for calculating MBBF, what we did? So we said what is the total of current assets, right? Okay. Then we said what are all the current liabilities except bank borrowings. Okay, what are all the current liabilities except bank borrowings? Okay, then we found out the difference, something called working capital gap. So based on this, we said you bring some margin. Let us say the minimum margin is 25% of current assets, is the borrowings margin, right? Minimum margin, and then the bank will finance the balance portion, working capital gap minus this portion. We have seen this in a previous chapter. Okay, now look at this point. Working capital. Let us say take some figures. Okay, let us say this is 100 lakhs and this is say 40 lakhs. This is 60 lakhs working capital gap, right? If a company is availing LC limit, right? So there will be something called LC creditors, because this company is purchasing raw material on credit from a foreign supplier, right? And this is a use and LC. Okay, this is a use and LC. So the company has got some time to pay the material. Okay, to pay the amount pertaining to this material. The company has got some time. Say for example 2 to 3 months. So it's a credit, right? So that should be reflected in the balance sheet under creditors. See, LC is a non-fund limit. Agreed. LC is a non-fund limit because bank is not giving any funds directly. But for a company point of view, think of it from the company's point of view. The material has arrived. The material has arrived, whereas the company has not made the payment. It has got some 2 to 3 months time. So this is a, so there will be some creditors, LC creditors. Besides your normal domestic creditors, this is a LC creditor. So that should be reflected in the balance sheet. If it is not reflected, what will happen? Say for example, this LC creditor has 20 lakhs. So actually this should be 60 lakhs. If you don't show this, you're projecting a higher working capital gap. Had this been shown, you got only 40 lakhs, and correspondingly your MPBF would have been lower. Because of not showing that, you're getting a higher MPBF. So it will amount to double finance. Okay, you'll be end up over financing the company. So whenever dealing with LC limits, always make the point that the LC limit should be reflected in the creditors, right? Alternatively, if that is not the case, right? If that is not the case, what should happen is your MPBF. Say for example, MPBF is 80 lakhs. Your LC is 20 lakhs. Then your MPBF should be assessed at 100 lakhs, right? Either your LC creditors should be reflected in your balance sheet, or your MPBF, if it is not reflected, your MPBF should include that LC limit also. So out of this 100 lakhs, 80 lakhs will be CC, right? And 20 lakhs will be LC, right? Either this or that, right? But it's always better to show the your LC stocks, LC creditors as part of your balance sheet creditors. Okay. So one more point that that's very important is banks take LCs very seriously, both LCs and BGs, as far as payment is concerned, right? Say for example, let us continue with the example. So we are the buyer. We bought this machine from a German supplier. The machine has arrived. Okay. So this is a site LC. So documents have come, and within 3 days we have to arrange the payment. However, we could not arrange the payment. Now our bank SBI will not wait for us till we make the payment. That is the beauty of LC. From the seller's point of view, from the German supplier point of view, that is the beauty. Because irrespective of whether we make the payment or not, that is the buyer. The buyer's bank, that is SBI, will compulsorily make the payment. That is the beauty of LC. Why LC is a safety? LC is a safety mechanism, especially for the seller. Because irrespective of whether we make the payment or not, as a buyer, the bank will be making the payment. Because LC is an international payment mechanism. In case SBI fails to make the payment, it will reflect very poorly on SBI, and there might arise a situation, right, where in future the international trading community will not accept LCs issued by SBI. As simple as that. That's why banks will never default on LCs, irrespective of whether the party makes the payment or not. Banks will always make the LC payment to the beneficiary. Okay, to the beneficiary's bank, right? Deutsche Bank in this example. Right? Is this point clear? Right? Because if SBI doesn't make the payment, it will result in loss of credibility, and in future the international community will not accept LCs by issued by SBI. For example, not by SBI. Let's assume it's some small bank. That's why usually if you see in international trading, small banks, LCs issued by small banks are not usually accepted. There should be a minimum standing for the bank. Okay, some big banks only. Right? That is in practice. Okay, so irrespective of whether the party makes the payment or not, the payment has to be made by the bank. Okay, because otherwise it will be a huge reputational issue. So with that we come to the end of this concept of LCs. Okay, so we'll continue the discussion on the non-fund limits. So the next non-fund limit we are going to discuss is the bank guarantee. Bank guarantee is also a non-fund limit, right? We define non-fund limit as a facility where bank doesn't part with funds. Okay, so BG is also a non-fund limit. In fact, it's just a piece of paper, right? I think you're aware of what BG is, that you might have encountered in your practice of banking. BG basically is a piece of paper issued by the bank. It is a promise. So this is section 126 of the Indian Contract Act, which defines what a guarantee is. Okay, so a guarantee is a contract to perform the promise, right, in case of default. So if a bank is giving a BG, say for example, we are a bank, our party is a contractor, some civil contractor. He got a work from a municipal corporation, say from the Mumbai Municipal Corporation. He's got some work, some road work, and this contractor is executing work, and the municipal corporation has asked the bank to furnish a bank guarantee. Bank guarantee is a non-fund limit, so which means that the bank will not give any funds to the municipal corporation. It's just a piece of paper saying we promise you that in case something wrong happens. Wrong in the sense that the contractor, for example, doesn't complete this work in time, or the quality is not as per the specifications. A variety of reasons that are described in the agreement. Okay, so in case something goes wrong, we will make good the payment. Okay, so that is a promise. It's just a piece of paper. In case something happens, that something might happen or might not happen. It's a contingent event. Okay, so in that case, the bank is saying we promise that we'll make the payment. Okay, so that is basically a bank guarantee. Right? In case of default, it arises only in the case of default. If everything goes smoothly, nothing. The bank guarantee will never convert into a fund-based facility. Right? But in case something goes wrong, the non-fund limit which you are speaking of will be converted into a fund-based facility, because bank then has to make the payment. In that case, it will be a fund facility. Okay. So usually BGs are common in a lot of government contracts, right? Roads, bridges, a lot of civil works. You see this government contracts. Okay. In case something wrong happens and the bank has to make the payment, then it is known as invoked. We say the bank guarantee has been invoked. In case of LC, we call it as devolvement, right? Right? In case LC is also a non-fund facility, isn't it? Right? In case the party fails to arrange the funds by the due date, and bank makes the payment, but because we discussed the bank somehow has to make the payment, right? Irrespective of whether the party has made the payment or not. In case the party doesn't make the payment in time, LC is said to be devolved. That is devolvement. In case of BG, we call that invocation, right? We said the BG has been invoked. Okay. So two terms which you need to be aware of. So why BGs are issued? BGs issued for a variety of reasons, right? There's something called bid bond guarantee. So in contracts, it's normal practice to participate in tenders, right? It's not that if a party bids for 20 tenders, it'll get each one of them. Maybe it'll get some 2 or 3, right? So it'll keep on bidding. So for bidding in a contract, right, there's something they have to furnish something called a bid bond guarantee. So that could be one purpose of a BG. In lieu of security deposits, sometimes say the municipal corporation which has floated this work, okay, might request for might insist on a security deposit from the contractor. It will say in case you are not able to furnish us, provide us the security deposit in cash, you can also, as an alternative, furnish bank guarantee, because both are one and the same. From the corporation point of view, both are one and the same. So in place of security deposit, also BGs are given. So mobilization advance, sometimes in large projects, usually this is for large projects. So it's say for example, it's a 100 crores project, huge project. A contractor has got to work for a huge project. So to execute this project, he needs some initial funds, right? See, the bill will be coming later. He completes some work, say 1 or 2 months work, then he raises the RA bill, okay, and then there's a processing, and it will come maybe 3 to 4 months later. It will come later, okay, for the payment cycle to start, okay. But in the initial period, because it's a huge project, he needs funds. So usually it is a practice in large projects that some mobilization advance will be given by the company to the contractor. Some money will be given, but then they won't give the money like that, So they need an assurance. So sometimes, the companies, what will they say to the contractor? You get a BG. So against the BG, will give mobilization advance. So that is also a purpose for which BG can be given. Then there's something called release of retention money. So usually what happens is contract is executed in phases. Okay. So say for example, it's a 12 months contract. The contract is going to happen for 12 months. The bill is going to be raised every month based on the progress of the work. So every month, say for example, this is a 12 crore project. Every month 1 crore payment is going to be released. Now what happens is that the party will not release the entire 1 crore to the contract. They'll retain some amount. Say for example, say 5% or 10%. Say, and they'll pay only 95 lakhs. So this 5 lakhs, this 5% is retained in every bill. It is retained. Why they do that? Right. Say for example, the work which the contractor has done is not satisfactory, which comes to light later. So then they will retain this. Then they will retain this fund. Then the contractor has to forego this amount. Okay. So sometimes the contractor will say, I want that money because I'm running tight on funds. I don't have sufficient funds. So then what the party will say, okay, you furnish a bank guarantee, against that will release the retention money. So that is also a purpose for which BG can be issued. Then there could be a performance guarantee, right? Performance guarantee is like, say for example, something happens. Now you promise us something happen. So contractor will say, we're going to do this, and he fails to do that. Then the bank has to make the payment. Okay, so that is a performance guarantee. Duty exemption also. Sometimes banks, sometimes BGs are provided. Bridge finance also BGs are provided. Bridge finance is like it's a stopgap arrangement. Okay, I think we discussed this earlier in some chapter. If not, basically it's a intermediate arrangement. Say for example, a company is going for IPO. Okay, IPO is a long drawn process, 3 months, 6 months, because a lot of process involved. You have to prepare the prospectus, the red herring prospectus. Yeah, a lot of stuff. I mean, it's not that you're going to raise the money from the public tomorrow. A lot of time involved. But maybe there's an immediate urgency funds. So the IPO, after 3 months, maybe you're going to get money. But in the meantime, you're an urgent for some project. You have to you have some urgent funds. Okay, so there's a finance called bridge finance. So for this intermittent period, the bridge finance will be extended. So once this 3 months completed, when the IPO funds come in, so this bridge loan is going to be closed out of this IPO proceeds. Okay, so for that purpose also BGs can be issued, though that's something you will not encounter very frequently in your career, right? So let us see assessment of BG. BG actually is very difficult to assess, because each BG is different. Now we said that BG is issued for a specific purpose. Okay, so based on the purpose you have to do the assessment. So each project is different, each contract is different. So how can you assess the BG? Banks have a guide. They break it up into various components. We discussed the various purposes for which BG can be issued. Right? So based on that, they have prepared a model. They follow that. But again, that is just a guide. Okay, don't there's nothing. Don't take it as a gospel truth. Okay, so based on that, you can modify as per your requirement. Basically, they break it down into various components. Okay, so every company will not require all the components. Okay. It's not that every company which applies for a BG limit requires bid bond guarantee, in lieu of security deposit, mobilization advance, retention money. Okay, all this, it's not that every company will require. Whatever a company requires, say for example, this company which we are, which a company has come for, applied for BG limit. Say for example, this company needs only these two: bid bond guarantee and security deposit. So based on that, we'll calculate. So for bid bond guarantee, there will be a simple calculation. Okay. So what are the contracts you're expecting in the next year? Total contracts, say 10 crores, right? So what is the bids you're going to participate? Right? Usually, say 10 times, because you're not going to get every project you're going to bid. So if a target is 10 crore, maybe you have to bid for 100 crores worth of projects. Okay. So what is the average monthly bid on an average? Let us say 8 crores average monthly bid. And what is the anticipated period for BG for bids? Say for example, one month. Right, so quantum of BG will be 8 crores. So it's a simple calculation. So based on the category of BG required, there will be some simple calculation. Okay, so you can follow this guideline, but again, a BG is issued for a specific purpose. So based on the particular case in hand, particular requirement, you have to assess that what is the BG requirement. Okay. What you need to be very aware of is there are two terms which are used in banking industry as far as BGs are concerned. One is a financial guarantee and another is a performance guarantee. Really, if you think about it, all guarantees are financial guarantees, but for the purpose of commission, right, to charge different commissions, banks usually have this classification, right? Financial guarantees have a separate margin, have a separate, say for example 3%, okay, and maybe performance guarantees will be 2%, something, right? Just for the difference of this commission, they have formulated these two guarantees. Basically, all BGs will end up being financial guarantees. Okay, so in case of financial guarantee, bank undertakes a financial liability. Okay, don't ask me. In case of performance guarantee, doesn't bank take a financial liability? It does. Again, I told you, in the end, all guarantees have financial guarantee. But for the purpose of distinction, let us assume that. Let us understand that financial guarantees, bank undertakes a financial liability. Examples are, we discussed the earnest money deposit, mobilization advance. Okay, all these are financial guarantee. Performance guarantees, bank will say we will make good the loss. We will make good any loss arising out of the non-fulfillment of contract. So there's a contract, there's an agreement based on which the work is going on. In case the party fails to fulfill the work as per this contract, we will make good the payment. Again, both financial guarantee and performance guarantee involve monetary liability and part of the bank. Okay, so it's just for the purpose of different commission structure. As discussed earlier, non-fund limits are referred to as contingent liability. Why? Because we don't know whether bank has to make the payment or not. Usually bank will not make the payment. These are just document based, paper based. Okay, the financial liability will arise only if something happens, right? What we discuss is LC devolvement or BG invocation. It is contingent upon some event happening. Say for example, this party to which have sanctioned this limit, he has failed to fulfill the contract. He has executed a contract, say a road work, stopped midway. Right? Only if something like that happens, the bank comes into the picture and makes the payment. Till that time, it's a non-fund limit, and we don't know at the beginning when we sanction the limit, we don't know whether it's that event is going to happen or not, right? We don't know, right? So it is contingent upon some event happening, right? So we refer to them as contingent liabilities, okay? And in the balance sheet, I'm speaking of the bank balance sheet, not the customer balance sheet, okay? Say for example, this is Bank of Baroda or PNB, okay? In the bank balance sheet, we don't show them under liability, right? There is a separate in the notes to account, separately we show something called contingent liability, okay? What is contingent liability? For a bank, we have balance sheet liabilities and assets. What are the liabilities for a bank? Your deposits, yeah? As savings deposit, current deposits, term deposits. What is the major type of asset? Loans and advances, okay? All the advance parties will be assets, okay? So liability, you might think that LCBG should come here because of liability, because bank has a liability to pay the pay to the municipal corporation if something wrong happens. But that depends on whether the contract was fulfilled or not. We don't know at the outset whether the invocation is going to happen or not. So we don't put them under liabilities. We put it separately into the notes to account separately under the head called contingent liability. Okay. So LC and BGs are contingent liabilities and they don't appear in the balance sheet. Okay. One more term you will come across very frequently is restrictive clause. Banks usually issue BGs with restrictive clause. So this is a common wording which you'll normally come across in BGs. Whenever bank issues BGs, this is a standard, this is a common language they use. Okay. So they say our liability under this BG shall not exceed so and so rupees. This BG is valid up to so and so date, and we are liable to pay the guarantee amount only if you serve upon a written claim on or before so and so date. So this is a standard language used by banks. So remember this term, okay, restrictive clause. So it will not, our liability will in no case will exceed this amount. Okay, so that's a restrictive clause. So as a banker, when a company approaches for sanction of BG limit, don't be lax. Okay, don't be casual. You know, don't show any distinction between a fund-based limit and a non-fund-based limit. You might be under the impression that fund-based limit is something that bank parts with the funds because it physically gives the money. So you have to be more careful while assessing OCC and term loans. You need not be so serious while assessing LCBG. Don't do that because ultimately if something goes wrong, this will be converted into fund-based facilities. Because bank has to make the payment if something goes wrong. So a couple of points you need to remember is one is you have to be confident of the capacity of the contractor to execute the particular contract. Okay, it's not that anybody comes for issue of BG and you give the BG. Okay, BG is basically what is the BG purpose? That beneficiary, that municipal corporation is asking for the bank's guarantee. Right? In case your party doesn't fulfill the contract, you have to pay us. So we have to be satisfied about the capacity of a borrower to execute this contract. Okay, so that's why usually we give it to our existing parties. Usually, right, who have some limits with us, some fund-based limits. I mean, okay. Usually we give BG limits or LC limits to parties who have some prior dealings with it. Okay, so you have to be satisfied about the capacity of this borrower to execute the contract successfully. Okay, then usually it happens, right? Banks issue BGs and then forget about it. Okay, don't do that. Okay, you have to regularly follow up. You have to understand what is the purpose of BG. If it's a performance guarantee, say for example, it's a performance guarantee, right? Say for example, the BG says in case this borrower doesn't complete this work by so and so date, we have to make the payment. So you have to periodically monitor the progress of the work, okay, for which this BG is issued. Okay, so that underlying contract, you have to understand the terms of this underlying agreement, and then you have to periodically monitor the progress of this project. Okay. Then usually it's very usual that BGs are issued in favor of government departments, and the original BGs will not be written even after they expired. Okay, BGs will be having a due date, right? We've seen that in the previous slide. Okay, restrictive clause, only before so and so date if you raise a claim, we will make the payment. Okay, sometimes what happens, the date gets passed and even then the banks don't ask for the return of the BG. Okay, you have to, in case there is no claim received, right, and the bank's liability period has expired, right, what you have to do in practice, banks will issue a registered notice acknowledgement due letter. Okay, this is what they do. Okay, in case the claim period is over and the claim is not raised by the beneficiary, what banks do, they will issue this letter to the beneficiary requesting to return the original documents, and they'll give a reasonable time, say 3 months. Right? You return by this time. Okay, and as I said, usually it's not sanctioned to borrowers who don't have a regular sanction limit. Usually you should insist on issuing LC and BG limits, non-fund limits to borrowers who have some fund-based limits with us. Okay, though that doesn't mean that you should not issue to new borrowers, but this is a practice that is followed in the banking industry. Okay. Then you also need to be aware of a number of frauds that are happening in BGs, especially from the bank offices. That because you have to be very, so that's why you have to be very careful. What happens is basically BG is a piece of paper. Just remember that BG is a piece of paper. So there is a there could be an incentive for the bank employee to engage in some fraud. Maybe he can just especially if it's a position of power. Say for example a branch manager. For example, he can, because just a piece of paper, he just sign it and say. Right, he'll issue a BG. So there have been a number of cases, fraudulent cases. So what banks usually do these days is they have put in place a number of checkpoints. Okay, so one check is that the BG usually signed by two officers, right? Sometimes what happens is the beneficiary. This is a normal practice, right? These days, what happens is the beneficiary. Say for example, the municipal corporation to which have issued the BG, they actually ask for the confirmation from the issuing bank that really you have issued the BG, right? So there is a branch manager who has fraudulently issued the BG. Right, in favor of say municipal corporation. Now the municipal corporation will ask confirmation from the bank that really this BG is issued. They won't write to the branch manager. That is ridiculous. Okay, if this branch manager has fraudulently furnished this BG, okay, there's no fun in going back to him and asking whether you have issued or not. So in a 3-tier setup, usually banks will be having a 3-tier setup. Okay, there's a branch, there's a circle office or a zonal office and the head office. So usually for BGs issued by branches, what the beneficiaries do is usually they get back to the zonal offices. And this they are confirm whether this BG was issued by your so and so manager. Okay, so that is something which is done. Okay, so in case it is not, in case the powers were exceeded, say for example the bank manager has got only powers to issue BGs of 25 lakhs, whereas he has issued a 10 crores BG possible. So then the zonal office will come to know, and then they can take then they can say we will not confirm, we are not aware of this. Okay, so then appropriate action can be taken, right? And as a credit officer, you will be getting these sort of request letters from beneficiaries saying, please confirm whether this BG is issued by a particular branch. So what you have to do, you have to number of things. You have a manual that maybe have a circular detailing what to do. Basically, what it does is you have to verify in the system that this LC and BG was entered. It's not just a piece of paper furnished by the manager fraudulently. It was actually entered in the system. Okay, and the number tallies you have to check. Then the powers, whether the manager actually has the powers to make that issue that BG, right? And also just pick up the phone and just call the branch, okay, and talk about to the officer or the manager whether the BG LC was really issued. Okay, these are some checkpoints that you can do. So the last point we are going to discuss in this chapter is standby letter of credit. It's very unlikely that you're going to come across this facility, but let's see what it is. We've seen what an LC is. Okay, so in LC we want something to happen. We want the transaction to be successful. Okay, so there is a supplier who is supplying the material to a foreign party. We want this transaction to happen because everything goes on smoothly. There is no devolvement of LC. We want something to happen. In standby LC, we don't want the payment to happen. Right? Contrast this with LC. In LC, we want everything to go on smoothly and the payment should happen. Whereas in standby letter of credit, we don't want the payment to happen. You can compare it with the it's an equivalent of BG. Right? In BG also we want this, right? We don't want the payment to happen. Okay, so only when the desired event does not take place, the payment will arise in case of standby LCs. So you might actually see both of these are one and the same. So actually the background is that in US, okay, so the national banks, right, they're not allowed to issue guarantees. So the standby LCs has evolved as a substitute guarantees in US. Okay, so in only that context, okay, you see standby letter of credit. In the Indian context, you're not going to come across this very frequently. Okay, so just keep this in mind. Okay, so with this we come to the end of this chapter of non-fund limits. So what we'll do in the next chapter is we'll discuss the very important concept of ratio analysis. But before that, we will have a short exercise to test the concepts we discussed in the chapter 8 and chapter 9. That is working capital assessment, both fund-based and non-fund based. So chapter 8 and chapter 9, whatever we discussed, we'll have a small exercise coming next, right? After that, we will continue with chapter 10, that is ratio analysis, right?